This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. The RBA surprises with a 25 basis point hike and says more tightening may be needed. The Aussie dollar jumps. European stocks are, unchanged. Christine Lagarde cements expectations of another rate hike next week. The ECB president actually says price pressures remain strong and borrowing costs will have to increase. And Ukraine says Russian forces have blown up a giant dam in the south of the country, unleashing a torrent of floodwater that threatens residents and complicates the battlefields. Now, let's also check, of course, on the markets. The ECB saying consumer expectations have decreased significantly. Now, this, of course, is to put into context. We also heard from Klassknot in Luxembourg, I believe, a little bit earlier on, saying what they've done with interest rates is now starting to feed into the real economy. ECB saying that consumer expectations decreased significantly does not necessarily mean that they will change their projections for interest rate increases. Again, the market pretty much expecting a June and then a July hike. What happens in September is, of course, the big story. The other big story is China trying to put more stimulus in the markets to try and spur consumer spending there, but also credit supply. That will be something that will play out, of course, in Asian markets tomorrow. For the moment, European stocks pretty much unchanged. European stocks getting 0.1%. And then, again, the fallout, or at least the understanding of what the unilateral Saudi Arabia decision over the weekend to cut more production means for crude oil is still trying to work its way through 75.67. Now, European map. There's not always a lot of difference between what we're seeing in the CAC 40 in France or the DAX, but you can see there's a little bit of a difference depending on the composition of some of these markets. So the DAX actually gaining 0.1%, where a lot of the other ones are unchanged. So Bloomberg has learned that Chinese authorities have asked the country's biggest banks to lower their deposit rates for at least the second time in less than a year. Now, the move marks an escalating effort to boost the world's second largest economy. For more, let's bring in Bloomberg's Valerie Teitel. Valerie, this is a huge deal because we've been asking ourselves, really for the last month and a half, what policymakers can do to try and prop up the economy.
Yes, that's right, Francine. This might be the first hint that there might be more official rate cuts to come. We had Bloomberg sources reporting that state-owned lenders were advised last week to cut rates on a variety of deposit products, ranging from duration of 3 to 5 year deposit rates. It's the second time in less than a year that China has done this. The last time they did it was back in September. These official banks, they may adjust those rates lower as soon as this week. I think the market might assume that this could overshadow, perhaps hint that an official rate cut could come in the loan prime rate on the next time China announces those rates, which is June 19th, so less than 2 weeks' time. The HSI index, that's the Hong Kong index, popped on this news, popped higher. Dollar CNH, that's the Chinese yuan, that moved lower on this news. The Chinese renminbi has continued to weaken on expectations of China easing, and then their 10-year yield moved slightly lower. Now, that goes to say we have a lot more data coming out of China this week. On Wednesday overnight, so tomorrow very early in the morning, we get their trade data. That's their export and import data. The market is going to be watching if this export engine, this export growth engine model that China has relied on is still there. And then on Friday, we get CPI and PPI. Perhaps the lower growth impulse, the slower growth impulse in China will play through to softening inflation figures. And then from June 19th to 15th, we'll get the May credit data. That's new yuan loans, any new private credit that's been extended in the Chinese economy. That will also give us a good glimpse on just how well the Chinese economy is holding up. Now that we know that this reopening trade, this reopening growth burst that many were expecting has started to dwindle.
Yeah, thank you, Valerie. Of course, Beijing, we know, has rolled out a raft of measures to prop up the economy after a series of crackdowns in multiple industries, but also lengthy lockdowns due to COVID. Our Valerie Teitel there looking at some of the market moves. Now, joining us now is Nick Scullion, partner at Foresight Group. Nick, thank you for joining us. To do or not to do, this is a problem for policymakers in China. At the margins, they're trying to support the economy. What does it mean for the rest of the world?
Well, good morning, Francine. Good to be back. Thank you for having me. Yes, of course, big news out of China this morning, asking central banks to cut. Clearly, that has big implications on a global scale. If we see, stimulus in China, then we are likely to see commodity prices resurging. Inflation could be stickier on a global basis, which could cause policymakers headaches on a global basis, not least in the US, Europe, and as we've seen in Australia this morning, already raising rates overnight, which was a surprise.
But so what does it mean? I mean, what China's trying to do, right, is they're trying to stimulate consumer spending and boost credit supply. So first of all, do we actually believe the data that came out of China that was already worrying, or could it be worse than expected?
Well, that's always a challenge, isn't it, when we're dealing with that particular
Especially when OPEC is also cutting supply. I mean, there's all these, I guess, alarm bells, right? I don't know how you interpret them.
Well, you're right, and we have to be very circumspect when we're looking at the data. But when we're thinking about, constructing our portfolios, what we're thinking about is what really matters here for global growth. And for us, what really matters is core inflation on a global basis coming down at the rate that we're being told that it is. We have seen, Christine Lagarde already saying this morning that there aren't major indicators that core inflation is getting back to where they need it to be. But we're really careful about looking at inflation and what that means for the next couple of quarters of policy decisions on a central bank basis.
So is there, and again, I guess if you look at the markets, they're unsure whether inflation is going to come down, far enough for central banks to ease off, or whether it's stuck at that 5-6% range, which is actually really tricky to get back to 2%. Yeah,
absolutely. And what we're seeing actually is, US interest rate swaps, inflation swaps for next year down at 2.1% already. That's a bit surprising given where we are and given where we've been. I think that there could be a bit of a expectation effect that you've got anchoring from many of the analysts that are just looking at long-term economic forecasts and not really looking at the world around us. However, I think that there is a good case to say that core inflation follows headline inflation with a lag, and that is being somewhat underappreciated by the market. So we think that, the outlook for a soft landing has somewhat increased in the last couple of months. That potentially is being underappreciated by the market. We think that if there is a soft landing, well, that's broadly good news for equities. It means that interest rate policy can become much more stable, much more circumspect. We won't see rapid rate rises or falls. And if the discount rate is no longer what's pushing around valuations, it becomes all about earnings quality. And that's how we manage our portfolios, looking at the quality of earnings.
So first of all, what does a soft landing look like? I guess a slowdown in growth, but without a credit crunch, or we're starting to hear actually on both sides of the Atlantic, for example, some of the lending figures being significantly curtailed.
So I think a slowdown in growth is right, but what we really need to see is no major crack in the labour market. So we saw some really interesting data on Friday where we saw, strong non-farm payrolls, but we also saw a rise in the unemployment figures. Those two coming together was interesting in how the market responded. However, the data shows that if the US sees a 0.3% increase in the unemployment rate, there will be a recession. That's what we've seen in the past. So we've come in just under that. What's actually frightening, though, is if you see that rate get to 0.5%, it tends not to stop until it gets to 2%. An increase of 2% would be pretty dramatic and would lead to a pretty severe economic recession, we think.
So when you look at earnings and you're basically, I don't know whether it's stock picking or kind of trying to find value in it, is it exposure to China, or how do you make a difference between a stock that actually is time to sell and time to buy?
No, so for us, it's all about the quality of earnings. So it's the counterparties, it's the duration of the cash flows. And, we're looking for critical assets on the whole. So infrastructure assets, renewable energy, digital infrastructure, critical services to society tend to do well during recessions anyway. But counterparty is extremely important. So exposure to China would be problematic. Broader EM exposure would have the political uncertainty that we're looking to avoid at this stage. So it's companies that have high quality earnings from long duration cash flows, government counterparties, but with that inflation protection embedded within those contract structures that make the medium term an interesting perspective for us.
All right, Nick, thank you so much for coming on today. Nick Scully and their partner
Francine.
at Foresight Group. Now, coming up, President Christine Lagarde remains hawkish in the lead up to the ECB's policy decision later this month. We discuss the central bank's rate path and the euro area economy next. This is Bloomberg.
We expected inflation to hold for longer. We're now at 6%. Potentially, we can have surprises on the decline of inflation. The ECB has raised very fast and a lot, and there is always a lag between when you tighten and when it takes grip on the economy. And I think we haven't given it time to take grip on the economy, so we may see a slowdown of the inflation very, very fast, as we have raised very, very fast. So potentially we're in a better situation than people expected. We got a boost from interest rates. Yeah. Everybody talks about the boost, nobody talks about the negative from it. But anyway, that is how it is. And we have a convergence of the deposit cost to that level. From the second quarter of this year, we are going to have a reverse, where rates are going to go up less, but the so-called pass-through is going to increase. So that will create a headwind for all banks. And I think the market is very focused on that, but in a way, it's important to be focused on that, but they're missing the whole picture. The whole picture is, one, Europe is going from minus 50 basis points to lending rates of, I'll let you guess, 2.5, 2.25, 2.75. That is massive. When rates stabilize and it comes back down, fees rise. People stop investing in accounts of the bank and start buying back asset management products, unit-linked, increase their payments dynamic because transactions start again faster. So these things offset the compression from rates. And then I think for people who have been focused, and we're very focused, it is a trigger to be very, very focused on efficiency. And we're determined to get our cost to decline in spite of the inflationary environment. So for us, it means absorbing 500 million of adverse cost effect, and at the moment we are. So if you put it all together, maybe between 23 and 24, you're not going to see growth, or you're going to see more limited growth. But as this stabilizes, then from the second part of 24 into 25, you're going to see a lot more growth from the banks.
UniCredit Chief Executive Officer Adrian there speaking at the Bloomberg Italy Capital Markets Forum. Now, as the full effects of the ECB's rapid tightening campaign continue to work through the economy, President Kriti Gupta says inflation pressures remain powerful. She added that higher rates will be needed to tackle them. Her comments cement expectations for another hike at next week's meeting. Now, for more, let's bring in Bloomberg's Western Europe economy editor, Zoe Schneeweiss. Zoe, thank you for joining us again. We also heard from Classic Notes explaining the read across. So they hiked rates. When are we expecting it to be fully priced into the economy?
So this takes a while. As you know, transmission, the UniCredit CEO just mentioned that it takes a while for the hiking rates to actually feed through. So we're seeing it in some areas already. Lending is slowing. But the question is now with inflation itself, up until now, all the slowdown we've seen in inflation, and it has slowed down significantly. Back in October, it was over 10%, and now it dropped down to 6.1. And that now means that all that has been because of energy prices. The base effect with energy. A year ago, energy was soaring, and so now, a year later, those energy prices, that then slows down. But what the ECB is doing has not yet actually shown up in inflation rates. So that can take up to 18 months. So we still have a bit of time there, which is why some policymakers say we'll hike next week, we'll hike again in July. But after that, we probably just can hold and wait for a while, whereas some of the more hawkish members have said probably we need to think about September as well.
Yeah, so talk us through the trend for inflation. So at the moment, it's come down quite rapidly, and we saw that in the numbers. Yeah. But it could get stopped. This core inflation could get stopped at the 5.5 level, I guess.
Exactly. Core inflation is the one that policymakers now really have shifted their attention to. Of course, their mandate is on headline inflation, which is 3 times the actual rate that they want. They want 2%, and they're at 6.1. But core inflation has stayed much, much higher, and the danger is here, and economists are predicting that in the third quarter, so the July through September period, core inflation actually will be stronger for headline inflation. And you mentioned Klaas Knot, the Dutch central banker. He said today that now they're seeing second-round effects. They're seeing this high energy prices actually moving into services, and they see them in wages. And that means just that strong inflation is staying entrenched, and that means even if the ECB, let's say, holds in July, they might then have holds after July. They might then have to stay at that level for quite a while.
Zoe, thank you so much, as always, for some great explanations. Our Bloomberg Western Europe economy editor, Zoe Schneeweiss. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Australia's central bank has unexpectedly raised its key interest rate and says more hikes may be needed. The RBA increased its cash rate by a quarter percentage point to 4.1%, the highest level since 2012. That's as Australia's inflation remains well above target and labour costs also jump. Economists were expecting rates to stay on hold. Now, the SEC has accused Binance of engaging in a, quote, extensive web of deception and a calculated evasion of the law. The US regulator also alleges the crypto exchange misled investors about its trading controls. Binance says it engaged with the SEC in good faith negotiations and will defend the platform vigorously. The list of digital tokens deemed as unregistered securities by the SEC now spans over $115 billion of crypto assets. And an industry lobby group is warning that the UK risks falling behind in key technologies, including AI and also semiconductors. Tech UK, which has almost 1,000 members, including Apple and Amazon, says the government needs to urgently overhaul its policies and regulations. The report calls the UK a broken economy for growing startups and describes its regulation as, quote, expensive and also awkward. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Now, flooding fears as Ukraine accuses Russia of blowing up a giant dam in the country's south. We'll bring you the very latest on that story, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Ukraine has accused Russian forces of blowing up a giant dam in the country's south. The explosion has unleashed a torrent of floodwater that threatens residents along the Dnipro River. Now, let's get more with Bloomberg's Ross Matheson. Ross, what do we actually know this so far?
Well, we know there's been a catastrophic amount of damage to this important hydroelectric power plant, which is on this dam in the south of Ukraine. You can see there's footage of floodwaters cascading out of the area at speed and what looks like significant damage to whatever was holding those waters back. Of course, Ukraine says that Russia has blown up the dam. And of course, there was also evidence that Russia was mining the dam some months ago. And what we know is those waters are moving south. They're moving towards key cities, including Kherson, which Russia occupied for a period after it invaded last year. This is really the economic heartland also of Ukraine, the south and the east of the country, important areas for agriculture, important areas for industry, important areas also for the environment of Ukraine. And this floodwater could do major damage to all of those things, perhaps moving even towards Crimea itself. It's very early days. The Ukrainians are warning there could be catastrophic damage to the area from this flooding. There could also be some sort of risk to the nuclear power plant, the Zaporizhzhia nuclear power plant, which is idle, but it does use these waters for cooling, and there are backups for that at the moment. But if those backups run out, there could be key questions about the safety of that nuclear plant going forward.
And we know, of course, that it's a developing story. It's extremely difficult to know what happens next. But strategically, you've laid out why it's important to Ukraine. Is there any insight into what the next step could be in this?
Well, it comes, of course, as we know that Ukraine has either been gearing up or has already begun some sort of counteroffensive in the east and the south to reclaim land back from Russia. We saw fierce fighting in the Donetsk area in the past couple of days. And so this kind of comes at a time we're expecting a pickup in activity on the ground, and Russia obviously concerned that Ukraine is massing its offensive. And if indeed Russia did blow up this dam, it's probably designed to push those Ukrainian forces back, to make it very difficult for them to make advances on the ground, of course, occupied with a big humanitarian disaster, environmental disaster, and so on in the area across this key river, the Dnipro River. And Russia may just be wanting to sustain its existing positions rather than trying to hold Ukraine off, because the longer the Russian troops can sit there, obviously, the more complicated it becomes for Ukraine. If they can see through this offensive in the coming months by doing damage in the area, a la via this dam, then perhaps they'll be a bit successful in the longer term. So it might actually enable Russia to hold off Ukraine for a bit longer as a result.
Ros, thank you so much. Ros Matheson with the very latest, of course, on Ukraine. Coming up, we'll go back to the markets after the RBA's surprise hike. We'll be joined by Adrian Durham as well, FNZ Chief Executive. He joins us for that conversation. Then we have an important conversation also on crypto. The other piece of news is China asking some of the big banks to cut deposit rates again to boost the economy. All of that coming up, and this is Bloomberg. The RBA surprises with a 25 basis point hike and says more tightening may be needed. The Aussie dollar jumps, European stocks are lower. Christine Lagarde cements expectations of another rate hike next week, while the ECB president says price pressures remain strong and borrowing costs will have to increase. And Ukraine says Russian forces have blown up a giant dam in the south of the country, unleashing a torrent of floodwater that threatens residents and complicates the battlefield. Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get more on the markets as the RBA surprises traders with another hike, raising its cash rate to 4.1%, the highest since April 2012. So what will this mean for other central banks going forward? Well, joining us now is Adrian Durham, the founder and chief executive officer of FNZ. Adrian, thank you so much for joining us. Now, we link central banks to what you do because, of course, everything changes when interest rates go up for financial services. Yep. First of all, how do you see this ever-evolving interest rate hikes, ever-evolving technology, and change in operations impacting the way we bank and manage our assets?
Yeah, sure. So I think the trend that we really see in financial services today is about, and particularly in wealth management where we operate, is about ever-increasing personalisation of these services. It's all about me, how I achieve my goals, and how I can have a solution tailored specifically for me, which I think is something we've seen in many other industries over the last 20 years, but which has just come to the sector. And I think that's directly relevant in a world where inflation is higher. You know, people have more challenging goals and they need more challenging solutions to achieve those, and it's all about personalisation.
Adrian, you have an amazing story. You founded, this company FNZ, and it's amazing the growth trajectory that you've seen. And now you're launching more products and also partnering with some banks. What surprised you the most in this journey to wealth management?
Yeah, I think so. Wealth management is an extremely complex industry, which I think is why it's taken longer for the impact of technology to really translate into a benefit to the consumer. But the approach we've taken is very much to partner on a B2B basis with suppliers of wealth manager, take over their back office, move it onto a modern technology platform and serve it back to them in a way which really lets them focus on their customers, personalising, digitising and having transparent and fair services, which I think...
So this, I mean, I find this fascinating, and it's really an amazing story in the number of accounts you've been able to open. It's basically commoditizing the back office so that individual banks can give that premium service to their clients. Is that the way the industry will continue going as a whole?
Exactly. So, you know, as a consumer in this space, I care about how my money is invested. I care about the advice I receive and the trust I have with my advisor. Everything else kind of needs to fade into the background, and that's where technology and automation and extreme automation of these processes can really enable the things which matter to be the focus of those in the sector, and so that's absolutely what it's about.
So I guess the difficulty is, do you get disrupted by AI? We're trying to figure out exactly what AI means for markets and the way things are open, even for example bank accounts.
Yeah, I think. I don't think we necessarily get disrupted by AI, but it's an enormous benefit in terms of us enabling us to take automation to the next level. The more and more we can take complex processes, scale them, require less people. I think AI is a key enabler of that. And a technology that we deploy already to take automation to the next level.
But, and again, what's amazing is that you come from a really privileged position of understanding what wealth managers are doing right and doing wrong. Are we expecting consolidation phase? Already it started, but if you don't have a good value proposition and you're basically opening the accounts for them, like, will they have to merge?
I think we actually don't. We support a model which is not necessarily consolidated. If we take all the pain away of not just opening accounts, but funding those accounts, investing those, providing the reporting and managing all the regulation, then that enables a model which either operates at a lot of scale, and we have a lot of customers who are very large scale global banks, but also enables the independent model, which actually has been the general trend for a long time. So I think it supports both ends of the scale spectrum and and means actually you don't necessarily need to consolidate, at least as a provider of financial advice, in order to provide an efficient, cost-effective and personalised service for your customers.
I know you've partnered, for example, with Virgin Money to deliver an app for retail investors. You're expecting a lot more of these apps. Like, where are you seeing growth in terms of business model, but also what you're working on?
Yeah, we definitely enable and are excited about this world where we can, enable people to connect directly in a more accessible way with their financial goals and their wealth, and do that through technology and apps. And in our case, enabling that through partnerships with people like Virgin, trusted brands. And I think that's very much what drives our B2B model, very much drives much better model of delivery of services to consumers. I think we should also, wealth management is complex, and so a lot of people are still going to solve this problem, in combination of apps with people and trusted advisors, because the complexity is high, and ultimately that's a problem which is solved by a trusted relationship.
And I guess that also changes with interest rate rising. Does it impact your world?
I think interest rates rise, but inflation has risen as well. So real investment returns are still not that different to what they've always been, which means over the long term, people are going to still invest in growth assets and benefit from growth assets. And so it's just as important as ever for us to provide services which enable people to save regularly and to take risk. And so I don't see that fundamentally changing, except over the very short term when things change quickly.
Adrian, you're also one of the most interesting. I mean, you're a founder and chief executive in a fast-growing company that's doing very well. Like, longer term, what's your plan for the company? Would you ever sell?
I think we've just we built a very successful business in the UK. We've expanded that internationally. And just recently into the US market, which is the largest scale wealth management market by multiple. And so we're very focused on executing that growth. We've made a lot of progress, and so executing that, which I think is a multi-year story for us, still is very much our top priority, rather than thinking about any other potential future liquidity event. I think we're actually just at the relatively early stages of what we can grow this business into.
Is the US harder than the UK?
It's actually, I think, is fundamentally the same set of challenges. Very dated technology infrastructure that, in this technology-enabled way, has an adverse impact on the customer experience. So I think the opportunity in the US for us is exactly the same as what has helped us to prosper and be successful here and in Europe. And so we're very excited about that. And when you have a business in one country and you can apply it successfully to many others with effectively the same solution and the same the same benefits, that's very exciting.
So Adrian, apart from market share, what's your biggest challenge that you have to get right? Is it how you process data, or some of the data centers?
I think actually, in this space, it's if you have a successful business model and proposition, which we do, it always comes down to execution and sort of day in, day out execution, and in our case, managing that across 25, 26 different countries. That's where the complexity and the challenge lies. And that's where we focus.
Okay, wonderful to have you on. Thank you so much.
Thank you very much for your time,
Adrian. I'm sure we'll interview you again. As you have breaking news. Adrian Durham, the FNZ's founder and chief executive officer. Now, we're also getting some breaking news, as we usually do, around 9:30 a.m. UK time. This is May construction PMI rising to 51.6. Again, anything above 50 means that it's an expansion territory, and it is actually, if I can get my words out, better than expected. Economists had forecast a 50.8 figure. It's coming up 51.6. 6. Now, coming up, we'll speak to the chief executive officer of a software company that's just launched in the UK, as a new report calls Britain a broken economy for growing startups. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, a group of almost 1,000 tech companies has warned the UK risks falling behind in key technologies like AI and semiconductor. That's if the government does not urgently overhaul its policies and regulations. Well, lobby group Tech UK has called Britain a broken economy for growing startups. But there are tech companies that are actually still choosing the UK, like HR and payment software startup Rippling. Now, to find out why, we're joined by Parker Conrad, the chief executive officer and co-founder of Rippling. Parker, thank you for joining us.
Thanks for having me.
This is exciting because, A, you raised quite a lot of money quite quickly, and this is to basically kickstart something in the UK that would be what, a template for the way that HR manages things elsewhere.
I think that's right. Yeah, Rippling's an all-in-one system for payroll and HR and a few other things as well. And we're launching this week into the UK.
And so what happens if it's successful in the UK? I mean, do you see the UK as a template of what could happen in other European countries or even other jurisdictions?
Yeah, I think that's right. I mean, we think of the UK as sort of the best market for tech early adopters in Europe, and this could be the first step for us.
Yeah, and we've seen a number of big Wall Street firms, right, trying to do the same with bank cards. How long do you have the UK experiment to see whether it works and you roll it out in other European countries?
We'll see. I mean, it depends how well it goes. I think it could be quite quick. I think we're establishing sort of a presence in a bunch of different places.
Talk to me a little bit about, first of all, the problem with legacy payroll providers. Like, you own this market, certainly in the US. Like, why was there an entry point?
Yeah, I think one of the things you see in the UK market in particular is that you have a lot of different systems that need to be brought together to run payroll. You have usually an HRIS system, something for annual leaves, for pensions, for payroll. You've got to send files over to your bank. There's a lot of manual process going back and forth with this. What we do with Rippling is we say, hey, look, it makes no sense to have all these things be separate. If you bring them all together into one system, you just go in, it looks good, you click a button to click submit, and the money's on its way to your employees. Rippling's a 2,000-person company. I personally run payroll for our company across employees in a dozen different countries for our business, and it makes it really easy for all of our customers to do the same.
So how much are you expecting to grow? I mean, I don't know the market share in the UK or whether you even have a global figure.
Rippling is, as a business, we're roughly doubling year over year. In the UK, we've got a core group of about 15 to 20 people that are working in our office here just to kind of kick things off, and we expect to sort of triple or quadruple that team this year.
Parker, I mean, some of the figures around Rippling are quite incredible. So you raised $500 million in less than 12 hours. You have a valuation, we understand, of just over $11 billion. And this is also because SVB collapsed. Talk us through the linkage.
Yeah, so what happened is in the United States, the way things work is that companies actually send payroll funds to their payroll company a few days ahead of when their employees get paid. We used SVB as the sort of rails for a lot of our banking in the US for our customers. And so when the bank collapsed, I woke up on a Friday morning and discovered unexpectedly that all of the funds that we were paying out to our clients' employees were still stuck at the bank in receivership. We made a very difficult decision in order to make sure that people got paid. We wired about $130 million of our own capital to JP Morgan Chase, and essentially double paid the payroll to make sure that people got paid that day. And as part of that process, we also kicked off a quick fundraising round to sort of make sure that we had enough capital to be able to do that.
I mean, it's a big gamble if then they hadn't guaranteed what happened on SVB.
Yeah, that's right. I mean, when we decided to do that on Friday, it wasn't totally clear what was going to happen. By the end of the weekend, of course, the FDIC stepped in and all the funds were released on Monday morning.
Yeah, I feel like that weekend is tattooed in my brain, like many of us.
Yeah, it was a stressful time.
I mean, did it make the strategy is basically you're I guess trying to do good. Does it make customers more loyal when you take difficult decisions? You could have lost $100 million. Is that fair to say?
Well, I mean, we thought it was just there were hundreds of thousands of, in this case, Americans that were expecting to be paid, and we felt very strongly that our clients had sent us this money, and we were going to make sure that it got delivered to their employees.
So, Parker, by now, I guess, entering the UK market, do you think it changes this prospect for UK businesses, especially the small and medium enterprises that are really the backbone of the UK economy?
Yeah, I think a lot of UK businesses spend, 5 or 6 days a month, even small businesses, dealing with payroll. And so I think we can take that and really dramatically cut that down. Like I said, I spend, probably just, a few minutes or just a few hours a month running payroll for our 2,000-person multinational company. And so I think we can really reduce the time and the administrative burden on businesses that's required from a lot of these processes.
Yeah, and it means that they're more, we talked about this, it basically means, they can do more strategy, more of the important stuff that makes their company grow. After the UK, what's next? Is there a country or a region that you want to expand in?
I think for us, we're looking at sort of working with the EU market, but for right now, we're focused on the UK.
So again, this is a one-stop shop to look at HR, IT, and finance globally. Do you have to have conversation with the government, or no? It doesn't really. This is a private company. You don't have to get the go-ahead or anyone from regulation.
Well, it depends country by country. Okay. So, in the UK, for example, we work with the HMRC to make sure that we can right. file and pay taxes on behalf of our customers and help with that process. And country by country, there are sort of different processes to follow to sort of make sure that you're set up to work with the governments in those countries. And again,
do you need data centers for this, or how to process? How does it work?
Yeah, so we set up we set up infrastructure so that clients can choose where they want their right. data hosted, because obviously that's really critical when you're operating in these right. different markets for businesses to be able to have that choice. And
I imagine that changes, right, if you're a European-based company than if you're in the US because of rules.
Of course. Well, a lot of businesses, in the EU in particular, want to make sure that their data is hosted there.
Yeah. Okay, Parker, what a fabulous, interview. Thank you so much for making the time for coming on, and we'll get you back on in like 3-4 months to see how it's going.
Thank you very much.
Parker Conrad, Chief Executive Officer and co-founder of Rippling. Coming up, Prime Minister of Italy, Giorgia Meloni, faces a few challenges ahead, key among them reviving Italy's economy. We'll discuss that next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to a Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Apple has unveiled its first new major product category since 2015. Its much anticipated Vision Pro mixed reality headset comes with a price tag of around $3,500. Meta's industry-leading headset sells for $1,000. Now, Bloomberg understands Indian education startup Baidu has elected not to make further payments on a $1.2 billion loan after a dispute with lenders. The move escalates a conflict that could jeopardize the future of one of India's highest flying startups. Baidu has been trying to strike a deal with creditors to restructure the loan, while also seeking to list its tutoring unit next year. China's Evergrande's property unit has delivered a delay earnings report that may bring its shares closer to a resumption of trading. Evergrande Property Services Group reported a profit of just under $200 million for 2022. That's reversed a prior year loss but fell short of 2020's result. The stock of China's most indebted developer has been suspended for more than a year. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Now, top of Prime Minister Giorgia Meloni's Italy First agenda is the creation of national champions in areas from energy to fashion and luxury, and a sovereign wealth fund to finance them. Now, for more on all of that, our Bloomberg Big Take Scoop, let's bring in Alessandra Migliaccio, our Western Europe economy reporter in Rome. Alessandra, thank you once again for joining us, and congratulations on a great Big Take. How is Meloni implementing her new vision for Italy?
Thank you, Francine. Thank you for having me. Well, Meloni is essentially putting all her people in very strategic posts. Some of that is luck. She has the luck to be in power at a time when a lot of these posts are coming up. And so she can nominate people in very big companies. We're talking about things like Eni. Eni is one of Europe's and one of the world's biggest oil companies. Enel has assets all over the world. It's an energy company, particularly Latin America. There's Leonardo. It's a huge defense company. So they're very strategic companies, important all over the world. They make a lot of money. And she's putting people that she believes, will continue her vision, even if the government happens to fall, which we know in Italy happens often. So it is really a strategic vision that will go on even after she's gone.
So what do investors think of this? If people are concerned about when she came to power because of her far-right, populism ideas, have they done a reversal on this?
Well, here's the thing. She's playing a very fine game, and so far it's working. I think essentially, internally, she's still that populist, anti-immigrant, anti-LGBTQ rights person, but more and more outside, externally, and from the economic point of view, she's very wise and she's being moderate. She is not. Markets are taking it very well. She's not doing anything uncautious on the economy. She's being careful about debt, careful about deficit, which is a huge problem for Italy, and we can see that with the spread. The spread between Italian and German bonds has not really moved that much, and it's much lower than it was a year ago. So her strategy is working of this moderate stance outside the country.
What about her vision on China? It looks like she'll pull out of the Belt and Road. What does that mean for Italian business?
So this is a real problem for Meloni because she has this nationalist view, and part of her whole program is also she doesn't want to alienate the U.S. in any way. She wants to be a good ally. She wants to show she's playing the game and she's not an outsider. And so she wants to pull out of Belt and Road, but Italy has over 2,000 companies involved in China. They're heavily involved. You have companies like Fincantieri, the big shipbuilders. You have Brembo. They make brakes for Ferrari, for example. And they're very worried because it's happening really fast and they were very involved. So they may not have time, if Italy pulls out and China retaliates, to protect their businesses from what may happen.
All right, Alessandra, as always, thank you so much for joining us. Great reporting there on The Big Take with Alessandra Migliaccio, our Western European economy reporter in Rome. We're also getting some breaking news. We understand that German and Indian companies have been nearing a deal to build submarines in India. We'll, of course, get you more news on that. This is just breaking news, just crossing the Bloomberg terminal in the last 1 minute or so. Now, Bloomberg Surveillance Early Edition continues in the next hour. A full market roundup. This is Bloomberg.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York and 5 p.m. in Hong Kong. Our top stories today. The RBA surprises markets with a 25 basis point hike and says more tightening may be needed. The Aussie dollar jumps. Apple unveils its long-awaited mixed reality headset, but investors are skeptical of the eye-watering price tag. And the SEC sues Binance and the CEO, Changpeng Zhao, for allegedly breaking securities rules. The crypto exchange calls the complaint disappointing and misguided. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. And Kriti, a bit of softness in markets today, a bit of softness in the data stateside, particularly on services coming through yesterday.
Yeah, it all comes down to that question of, are we getting closer and closer to that recession that I think a lot of people have been predicting is just around the corner for 2 years now, Anna. But now as we get data like the services ISM stateside yesterday, this suggests, well, maybe that slowdown in the biggest part of the U.S. economy, well, it's coming way faster than we expected. And that really weighed on sentiment in yesterday's trading session, largely weighing on sentiment today as well. As you see, futures really down about 0.1%. And again, this is not a massive move to the downside, but given the context in the last couple of days, futures have kind of remained unchanged at this time. this is, I would say, a little bit more conviction in the idea that it is a little bit of a down day. You're seeing that as well when it comes to the bond market. The idea, again, that perhaps the Federal Reserve needs to be repriced. You're looking at a 2-year yield here that's down by about 2 basis points, 444 on that level. What's interesting here is that we're about a week away from the next Federal Reserve meeting, and we're here talking about whether or not the Fed needs to hit pause. I mean, that's what the market is pricing, but if you were starting to see a real slowdown, at what point does the market interpret that as a need to cut and therefore pushing the Federal Reserve? At least that's going to be the kind of conversation we have in the coming days as we get closer. As yields come down, it really influences the dollar as well, bringing that down. What's interesting to me, though, Anna, is just 24 hours ago, we were talking about this massive voluntary cut from OPEC, putting a floor under prices, and yet here we are again on NYMEX crude, testing that 70 level, down about 2.7% already. So what does that say in terms of the recessionary calls around the world? And speaking of those recessionary calls around the world, let's take a quick moment to look at what's happened overnight in Asia, because you saw a little bit of a mixed picture. You saw some real outperformance over in Japan. The Nikkei higher by almost 1% there. But the Hang Seng, the Chinese index, of course, unchanged, underperforming the broader gains you saw in the region. Worth mentioning, though, the real highlight was coming from the RBA, the Australian Central Bank. You are seeing strength in the Aussie dollar here after a surprise rate hike, as you mentioned at the top of the show. What does that say in terms of tackling inflation? Again, just a week away from the Federal Reserve meeting stateside. You are seeing strength in the Aussie dollar, higher by about 0.6%, as well as a little bit of a bump in the Aussie yield as well, Anna.
Yeah, really interesting, the RBA story, because even if there is no direct read across into the Fed or any other geography, there certainly had been, of course, this was a central bank that had been on hold and then starts to hike again. And so does that give us pause for thought when we come to think about central banks and our expectations there? This is the picture for European stocks then, on the back foot, down by 0.6%. Over in Italy, down by less than that in most of these markets, but modest weakness coming through, 0.5% lower on the London market. Healthcare providing one area of green, but most of the sectors are now in negative territory as we deteriorate a little bit as we go through this morning's session. One area of brightness has been the energy story, at least, one area of weight has been the energy story. Brent crude is down by 2.5%, and that is weighing on energy stocks, and we'll look for this to be replicated stateside perhaps, but after that initial bounce in response to the Saudi action, as Kriti, you pointed out, we're now seeing weakness in the oil price, down by 2.4% on Brent crude, and that is having an impact on those stocks that make their money from oil. Speaking of commodities, natural gas futures really in focus here when it comes to Europe. And we're not seeing much movement in today's market. But yesterday we saw a really big jump, a 20% jump. This is like months, you know, we knew and got used to during the invasion of Ukraine, the initial invasion of Ukraine. Of course, war ongoing there in dramatic fashion. But now we saw a 20% jump in gas prices just yesterday in the UK and on the European benchmark. A lot of people asking questions about how tight that market gets, whether LNG is tempted to Asia rather than into Europe. Here's a couple of currencies I put in because we've had some data out. The pound is interesting, 124.20, pretty flat really, but interesting construction data coming out. So the overall construction picture not that bad, but that was lifted by commercial and some of the civil engineering projects. On the home building front, we're down to levels of home building we haven't seen since 2009 as rates rise. The euro at 106.99, so flirting once again with that 107 or just below the 107 level. We heard Christine Lagarde at the ECB reasserting those expectations in markets. It seems that we'll get more hikes coming through from the ECB, including next week. But then look at inflation expectations. They have softened, and that is, though, quite a volatile number. Lots to discuss with our guests then, Kriti.
Yeah, absolutely. And at the top of that list, perhaps that surprise decision from Australia that seems to be having a kind of little pause for thought impact on investors around the world at the moment. More on that, which unexpectedly raised its key interest rate to the highest level since April of 2012 and kept the door open to further hikes. Joining us now to break it all down, Bloomberg Markets reporter Justina Lee. Justina, look, you cover central banks from around the world. What is kind of the thinking here in Australia, a country that noticeably has been having a hard time adopting the tighter policy regime, but also really tackling inflation?
I think the Australian Central Bank is finding itself in the shoes that a lot of monetary policymakers are in right now, which is that headline CPI has kind of crept down a little bit, but at the end of the day, it still seems very far from the target of around 2 to 3%. And headline CPI and core CPI is still like stickily high. And so putting together all of these things, I think that's why they decided to surprise markets with a rate hike and even signaled further tightening. Now, looking forward, economists are a bit split right now. Some see maybe more hikes coming forward, and some kind of expecting a pause anyway, because people are kind of expecting to see a bit of a slowdown in Australian growth, which should help curb further price increases as well.
And they did certainly reference the wages story, which looked quite standout in terms of the wages that are being agreed in Australia. Let me ask you, whilst we have you, Justina, about what's going on in China as well. China asking big banks to cut their deposit rates, again, to boost the economy. The support for the property sector in particular in China, very much mentioned last week by regulators and also talked about in markets today.
Yeah, exactly. I mean, that's like a completely different path from the rest of the world. But I think what China has experienced is kind of disappointment in what that post-COVID reopening boost has proven to be. And so now we've seen worsening data across, retail sales, industrial profits, the property sector. And what this move does is, it encourages banks to cut their deposit rates, which hopefully will mean they get to lower their lending rate and get money growth going again. But I think, in terms of the currency, what we have seen is further weakness in the yuan. And that's something that's, totally to be expected, given that China's going in the opposite direction from, especially the Fed right now.
Yeah, the monetary policy conversation stands in stark contrast, doesn't it, Justina? Thank you very much. Thanks for joining us. Bloomberg's Justina Lee with reflections on some of those big macro themes this morning. Let's get to the corporate agenda. Apple unveiled its long-awaited mixed reality headset at its annual Worldwide Developers Conference with a hefty price tag of $3,499. CEO Tim Cook spoke about the new product yesterday.
So in the same way that Mac introduced us to personal computing and iPhone introduced us to mobile computing, Apple Vision Pro will introduce us to spatial computing. This marks the beginning of a journey that will bring a new dimension to powerful personal technology.
So the future is spatial. Alex Webb of Bloomberg Quick Take joins us with reflections on this latest offering then from Apple. And we saw the stock stumble a little bit as they announced that price tag. Is that because the market worries that not enough individuals will pay, or that actually it isn't aimed at a mass market?
Yeah, it was interesting. There were two dips to the share price over the course of the sort of 2-hour presentation. The first one came when Apple showed the first use case that it saw, at least for this product, and it was businesses. Investors took that to mean this is a product they're going to target firstly at the enterprise. You can also partly infer that from the device's name. It's the Vision Pro, in the same way that we have the iPhone Pro. You can therefore perhaps suspect that sometime later down the line there'll be a non-Pro version that's a little bit cheaper. And that gets to the second idea. The price point, $3,500, $3,499. It had been reported it was going to be in the $3,000 range, so it's a little bit more expensive than that. That signals to the market this is not likely to be a mass market product. Mark Gurman, our colleague, has reported in the first year, which will be next year, not this one, Apple perhaps only expects to sell 900,000 units. It's quite a lot for a new product category, considerably less than the iPhone.
Well, during this unveiling, Alex, they also talked about some of their other products, like a new version of their MacBook, for example. To me, that immediately signals what the ripple effects are for the chip sector, which brings me to another story overnight. TSMC, specifically lowering their capex as a result of perhaps the chip demand that's slowing as well. What can you tell us about that part of the business?
Yeah, they'd already given a range of how much they expect to spend building out new capacity. It's going to be $32 billion, sort of the lower end of that range. The readings people take away from that is that they're not expecting a massive resurgence in demand, not least for laptops, but also for smartphones, which in the case of Apple is the lion's share of its business. Still, there had been some hope that the demand for AI chips that help with AI, might drive some demand at TSMC. It does make the chips for NVIDIA, the sort of equity star of the past few weeks, that is still a far smaller part of its business than what it does in making smartphones. So they're not going to be benefiting from that just yet. They may do in the years ahead.
Let me get your thoughts on crypto while we have you, Alex. The SEC's Binance lawsuit then, no doubt striking fear into many with exposure to the crypto space. Accusations of mishandling customer funds, misleading investors and regulators, breaking securities rules, all denied by Binance, but a long battle ahead, perhaps.
Yes, and it's certainly sent a further chill through the crypto sector. One person in the Bloomberg story said that it was a continuation of the crypto nuclear winter. Key thing here really is whether these are considered to be securities. The SEC is now saying that they identified 12 things that are traded on Binance's exchange that it thinks are securities. Therefore, if it's in breach of security law, that's a big problem. Leads to more regulation. That's a big problem as far as Binance is concerned. Leads to more regulation and is not something that crypto investors look on too positively.
Alex, thanks very much. Alex Webb joining us there with a number of tech themes and the crypto news flow. And if you're interested in that story on Binance, then catch Bloomberg Crypto. That is today at 1 p.m. New York time, 6 p.m. in London, the weekly show that covers the people, transactions and technology shaping the world of decentralized finance. Coming up on this program, Italy's first female prime minister looking to drive change in the economy, starting with corporate Italy. That's our big take story. We'll get full analysis from Italy for you next. And the narrow breadth in stocks looks untenable. That is the view of Aberdeen's James Athey. More on that still ahead. Plus, we'll be speaking to Liz Martin, senior economist at HSBC. Lots to discuss in terms of the UK construction sector, the European inflation expectations, and rate hikes still to come. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. The top of Prime Minister Giorgia Meloni's Italy First agenda is the creation of national champions in areas from energy to fashion and luxury, and the launch of a sovereign wealth fund to finance them all. For more on today's Bloomberg's Big Take, let's bring in Alessandra Migliaccio, who co-wrote the story. Alessandra, when I think Italy, I don't immediately think big corporate hub, and yet that's exactly what the Prime Minister seems to be shooting for here. How is that actually unfolding, given Italy's ties to Russia?
Well, you have a very good point, and it is what she's shooting for. She's a nationalist. She's shooting for national champions. And, you know, I mean, you're right. It's not what you think about, but Italy is a G7 country. It has a very big economy. And actually, did you know the biggest export is manufacturing and metal parts? It is not, you know, food and wine and what you may think. So she's shooting for national champions. She thinks that exactly Italy has the wrong image. More could be done. Examples, ENI is a state-run company that she has put her people into. ENI is one of the world's biggest oil companies. Then you have Enel. Enel is a very, very big energy company, has huge assets in Latin America there as well. It's partly state-run, and she's putting her people in. So she's doing that just for a number of companies, and she's also fortunate because, you know, it comes up every 3 years, and she was elected just when the nominations came up. That means that even if this government should fall, which, as you know, in Italy sometimes happens, her people will remain. So her vision can go on for several years. And that's really her goal.
Okay, so she's looking to reshape corporate Italy. Good morning, Alessandra. What do investors think of this? Because there had been concern amongst the investor community that she came from a far-right and populist politics. But has she shaped up to be what investors were expecting?
Well, from the investor's point of view, she has, because what she's doing is she's playing this very fine game, whereas internally she's still the populist, she's still anti-immigrant, she's still, you know, not for LGBTQ rights. There's still a lot of that. But outside, as far as the economy is concerned, she's very moderate. You have the spread between Italian and German bonds that is really very narrow compared to the past. It's much lower than it was last year. It's well below 200 basis points. So that's a sign that investors have seen that she's being careful on the deficit. She's being careful about debt. She's not spending wildly. And she is, you know, pushing this nationalist vision, but with a moderate stance. She's being careful, especially not to alienate her allies, which is key.
And speaking of not alienating her allies, one of those key allies is China at the end of the day. Talk to us about Italy's involvement with the Belt and Road Initiative. How's that worked in the past? Where might it go in the future?
Well, right, here's the thing. So it's an ally, it's an important ally because Italy is one of the few countries who actually signed this Belt and Road. But then at the same time now, Meloni wants to be a team player with her other peers in Europe and especially with the U.S. She wants to befriend the U.S. I mean, she has, but she wants to keep that going. So now she has to move away from China. She's hinted it. Her ministers have more than hinted it, and she's moving away from this Belt and Road deal. What does that mean? Well, it's not great news for companies, and so she's getting a lot of pressure from Italian companies because there are more than 2,000 Italian companies in China right now. Some of them are very big. Fincantieri is a huge shipbuilder. Brembo, for example, makes brakes for Ferrari. They're going to be in real trouble if China decides to retaliate because Italy is pulling out.
Alessandra, thank you very much. Alessandra Migliaccio in Rome for us. Thank you for bringing us the Big Take story. And you can find all of the Big Take stories on Bloomberg.com and by searching NI Big Take Go on the Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Now keeping up to date with news from around the world, here's the first word. Morgan Stanley is planning to move to a new office in Singapore as it looks to expand its presence in Asia. Bloomberg has learned the company is in advanced talks to take over 5 floors of towers currently under construction. A boom in private banking, family offices, and other financial services during the pandemic has bolstered demand for swanky offices in Singapore's business district. Jamie Dimon will be on Capitol Hill today. Bloomberg has learned the JP Morgan Chase CEO will meet privately with a group of moderate House Democrats to talk about banking and the U.S. economy. The closed-door lunch takes place as Dimon has been urged to enter the 2024 presidential race despite his protest that he does not plan to run. The Biden administration says military interception maneuvers by Chinese ships and planes suggest a growing aggressiveness from Beijing's national security. The council spokesman John Kirby says these actions risk an accident that could result in injury. The Pentagon says a Chinese warship last week crossed in front of a U.S. Navy vessel in the Taiwan Strait at a distance of less than 150 meters.
It won't be long before somebody gets hurt. That's the concern with these unsafe and unprofessional intercepts. They can lead to misunderstandings. They can lead to miscalculations. When you have pieces of metal that size, whether it's in the air or on the sea, and they're operating that close together, it wouldn't take much.
Ukraine says Russian forces have blown up a giant dam in the country's south. The blast has unleashed a torrent of water, putting 10 villages and parts of Kherson at risk of flooding. Residents are being told to prepare to evacuate. President Vladimir Zelensky summoned an urgent meeting of Ukraine's National Security and Defense Council to discuss the attack. And devastating images coming out of Ukraine, but interesting timing here as we hear reports of a potential counteroffensive from Ukraine as well.
Yeah, absolutely. The imagery of all that floodwater certainly makes you concerned for the people who are involved, front and foremost. And here we see, for our radio audience, just showing some of those images here on screen right now. This is a humanitarian story and very much, of course, part of the war narrative. Crop prices jumped on this, though, just to add in the market's angle, even though there doesn't seem to be much threat to crops directly in the path of this water, but certainly that was the risk from a market perspective. But to your wider point, Kriti, this does certainly seem to be coming at a time where everyone was braced for a spring or summer offensive. Counter-insurgency coming from Ukraine. Of course, the Ukrainians have told us they won't make it necessarily very obvious when that is going to start. It won't come with a big announcement, but this uptick in violence that we are seeing in the conflict right now, is that part of that insurgency, that fight back from Ukraine?
Yeah, and it's interesting what kind of international support it's gotten as well. We were just talking with our reporter over in Italy as well, talking about Giorgia Meloni and her stance, and simply her unwavering support on the Ukrainian story has actually lent her quite a bit of political capital from around the world. And it feels like as we talk about this counteroffensive, it's really seeping more and more into the conversation in Europe, in the United States, even in Asia, about where you stand and how that dictates the future of international relations as well. One of the key stories that caught my eye over the last few weeks, Anna, is this multi-billion-dollar plan out of Europe to continue the financing of Ukraine. So certainly something to watch on that front.
Absolutely. We'll be back to the macro themes shortly. Coming up, we'll talk to Aberdeen's James Athey on why he doesn't see a soft landing narrative dying so easily. In fact, he's talking about narrative tennis, just a nice way to encapsulate those looking at forward-looking indicators, those looking at backward-looking data, and thinking about how the stances of those two camps play out from here. More on the macro themes shortly. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The RBA surprises markets with a 25 basis point hike and says more tightening may be needed. The Aussie dollar jumps. And Apple unveils its long-awaited mixed reality headset, but investors are skeptical of the eye-watering price tag. And the SEC sues Binance and CEO Changpeng Zhao for allegedly breaking securities rules. The crypto exchange calls the complaint disappointing and misguided. I'm Kriti Gupta in New York with Anna Edwards in London. Anna, even though we have all of these kind of pieces of news on the micro front, the macro still seems to be around two words: inflation and recession.
Yeah, absolutely. And people's expectations around those two things moving around a little bit. Certainly when we saw that data, the weakness of that services ISM data coming out of the US certainly gave people a lot to think about after the strength of the data on Friday, certainly on the job creation side. This is the picture for European stocks, then pretty flat to negative on European stocks and not going anywhere very fast. Healthcare, one sector that's moving higher, but to the downside, we see the heavily weighted energy names under pressure as a result of a bit of weakness coming through in the oil price. Just what kind of floor have the Saudis put underneath Brent? We'll certainly continue to ask those questions. This is the natural gas price, and we put this in because it was up by more than 20% yesterday. This is the benchmark that we showed often at the start of the invasion of Ukraine, and it was where we were seeing a lot of the concern about gas supply in Europe being reflected. Yesterday, we saw that big jump for similar reasons, talking about issues around tightness in the market and whether LNG was going to be incentivized to go to Asia instead of staying here in Europe. It might be summer now, but of course, thoughts in that market always turning to the next winter. So we are seeing some pullback, but from elevated levels on the gas price. The pound is at 124.09, down by 0.2%. Interesting construction story developing here. The PMI for that particular part of the economy flattered by some civil engineering projects. But on the house building side, Kriti, the lowest level of construction we're seeing since 2009. Of course, if you exclude, the pandemic, that crucially also saw weakness in the construction space. And the euro is just down 0.1% or so, just under the 1.07 mark. Are we expecting another couple of interest rate hikes from the ECB? We heard from Christine Lagarde yesterday. She was talking about how the inflation struggle is still on. It's still active here in Europe. So that seems to be the market's expectation after hearing from her. But we are mindful of inflation expectations more broadly from the European people. And we are seeing some downward pressure there, although that is a very volatile set of data. Kriti, what do you see in the US?
Yeah, well, that downward pressure, that flat to negative sentiment that you were just outlining, Anna, certainly fueling perhaps equities a little bit to the downside, although not really having that major conviction or sell-off kind of tone just yet. All of that could change in just a few hours. Futures trading about 42.77 on the contract here, down about 0.1%. We'll call it that for our radio audience. The two-year yield, though, to me is what's more interesting, because as we see the kind of Fed get repriced, the idea of whether they need to go hard on inflation coming off those really hot payrolls numbers, or perhaps take a step back and perhaps hit that pause button with the market is pricing in off again. The ISM data you mentioned, Anna, that kind of tug of war between the narratives is really hitting the two-year yield, kind of going back and forth, re-entering that trading range, 444 on that, although down about 2 basis points. So seeing a little bit of a bid into the front end of the curve. As the yields come down, though, the dollar follows. So that bias that you are seeing, that weakness perhaps reflected in the greenback as well, but nothing I would really write home about just yet, because again, everything could change at those opening bells. NYMEX crude is what's interesting to me, though, because as we talk about inflation, it's the recession fears that are kind of creeping into the market. You really see that show up in the commodity space. A 70 handle on NYMEX crude already down 2%.
Okay, let's get into a markets conversation then, Kriti. We're joined by James Athey, Investment Director at Abrdn. James, very nice to have you with us today on Bloomberg TV. Let me start by asking about what you call narrative tennis. So the idea that we've got a couple of different competing narratives, at least two, in the market. Maybe there are other balls on the court as well. But how do you find that this is resolved? In which direction do you think we resolve this?
As you say, big picture, there are two narratives, but when you scratch beneath the surface, that there are definitely more. I mean, a sort of popular and very simplistic macro framework is a kind of quadrant approach, and you've got growth on one axis and inflation on the other, and whether growth is high and rising or sort of decelerating, and inflation likewise tells you something about the likely environment for macro investing. I reckon in the last 6 months, we've spent time in each of those quadrants. Stagflation, recession or no recession, inflation or deflation. And the data really has been volatile and inconsistent enough to support each of those narratives at a certain stage. And then globally and regionally, we've seen likewise, Europe and UK expected to have severe recessions because of energy prices flipping around and suddenly then becoming the sort of pro-cyclical investment of choice, and more recently, because China has slowed, Germany seems to be in technical recession, we've gone back again. Realistically, taking a big step back and trying to look at this from the highest level possible, it still appears to me everywhere that the data is trending down with a lot of volatility, but trending down. And the most recent data we had out of the US service sector really didn't look great, considering that has carried the bulk of the burden in recent months for growth generation. So my base case is still that the monetary tightening into a highly levered system that we have seen is ultimately taking us towards recession.
Okay, so that's the interest rates and what they're doing. Thinking of this like a tennis game, I mean, it almost seemed as if we got to match point and then have to wait to play that point another time in yesterday's session where we saw the S&P nearly into bull market territory then, James. What are your thoughts on whether this really is going to be a bull market or where stocks more broadly head from here? Morgan Stanley suggesting that the narrowness of this rally means, driven by moves in the dollar and the AI frenzy, the narrowness of this rally means that this isn't really what bull markets are made of.
No, exactly. I think a lot of people have observed and made that comment that normally when you start a new bull market, A, leadership changes, and B, it broadens. What we've seen here is basically the same very narrow set of mega cap tech stocks leading this bounce in the same way that they led the prior bull market. That's unusual. I think it's fair to say lots of things we're seeing are unusual and historically unprecedented or without precedent for quite some time. So it's difficult for me to say it can't be true. Ultimately, though, again, I think if recession is the likely outcome, it would be highly unlikely that we would start a new bull market while the Fed was still tightening policy, and indeed where 5 stocks basically do all of the work. All of that tells me that this is still a bear market rally, a painful one for bears and shorts, but ultimately the economic outturns will dictate where the broad indices head next, and I think as we move into the second half, that's going to be lower.
But James, let me push back on that idea, though. Why is leadership by a handful of stocks, similar to the leadership we saw in the last bull market, such a bad thing, given that the last bull market lasted 10 years or so and has significantly contributed to portfolios around the world, given that this time there's actual real money behind cloud, AI infrastructure, things that have really been accelerated by the pandemic? Why is it a bad thing to have such concentrated gains, given perhaps it's justified by the fundamentals?
Sure, yeah. I mean, it's not to say it's good or bad, Kriti. It is just to say that historically it's anomalous. We don't tend to see a sort of new bear market beginning with such narrow leadership, which is identical almost to the prior bull market. Again, that's not to say it can't happen, but when it comes to the fundamentals, I think one of the things that's been easily jettisoned over the last several years, largely because central banks have changed the nature of the game, is that investing is ultimately about value. It's not about just making a call on where earnings, where the economy are headed, but it's understanding what's discounted by the markets and investing on the basis of where there is value in doing so. And I think Amazon, a company which has been around for 3 decades, is highly mature and has seen rapid earnings growth from its non-core business, which is to say retail really doesn't make money now, and AWS has been an earnings machine. For it to be trading off a price earnings ratio of 114 suggests to me that maybe investors at this stage are overpaying for what is a high quality company. The examples that people always give, and I think they are highly valid, are things like Cisco and Sun Microsystems. You go back to 99, 2000, and they were priced for the sort of growth that they could not on balance achieve, certainly not while still seeing appreciation in their share price. And if you go back over that period, Cisco's annualized return is something around 0 to -1%. It's not a bad company. It wasn't a bad company. The narrative was absolutely correct, but the value just wasn't there as an investment.
It's an interesting point to make at a time when valuations in general are kind of being questioned as whether or not they should even be a factor. I want to bring to you a quote here from some of the strategists over at Citi, talking about kind of what you're talking about, perhaps with the opposite argument. With further support, they write, from the first quarter 2023 earnings and the uncertain macro environment, we believe the rotation from value to growth may continue. The potential Fed rate skip this month and cautious relative positioning in the equity market are tailwinds to growth performance as well. They're talking about that rotation to growth kind of coming in this environment of decelerating economic growth specifically. But argue the opposite for us here, James. Talk to us about the tailwinds in the value trade.
I mean, fundamentally, no, I'm not the opposite. I sort of understand the point that they're making, essentially, is that growth stocks have been seen as defensive in the sense that they've behaved a bit like duration because they've got this long profile of rising earnings revenue. The discount factor tends to be a bigger driver of current share price performance. So in an environment of falling yields, they should perform better than less sort of duration sensitive stocks, but also because recent history has said that a lot of these companies have been able to generate solid earnings growth almost regardless of economic outcomes. So if we are headed into a period of rocky economic performance, potentially disinflation, lower yields, lower Fed policy rates, all of that looks like a tailwind for growth. My hesitation is that, again, they are incredibly expensive. I would argue that they have already discounted a lot of the positives there, but they haven't really discounted a genuine economic recession. And I think some of these companies may see their earnings, their revenues being a bit more cyclically sensitive than is being priced. But this market has proven that momentum is such a powerful driver that trying to express that in the short term, can be a losing strategy. On the value side, it's more cyclical, but it's cheaper.
James, I just wonder if we are due a pullback in tech names then, I wonder how severe that becomes. I talked to Newton Investment Management earlier on, and they were asking themselves whether this is like 1999, and you alluded to that period earlier, and we all know what happened straight after that with the excitement over the dot-com boom. But they also wonder whether it could be 1994 and we're more at the foothills of the excitement. What are your thoughts?
I mean, I certainly hope it's not 1994 from a bond market perspective, because the Fed policy changes in 94 led to some serious losses. And I'm sure the Mexicans hope it's not 1994 because that really ended with them having the tequila crisis. Yeah, historical analogs by their very definition are a bit tricksy. I do think there are a lot of parallels to 1999, but I don't think the extreme of valuation broadly is quite as bad. But I think the leadership is much more narrow. But it's in businesses that I think we understand better, that are less speculative in terms of the nature of those business. So I'm not sure there's an exact parallel between either of those two historical analogs. Again, apologies for sort of being highly repetitive here, but I'm just going to fall back on the economics of the situation. And I think that will ultimately dictate whether I am right or whether I am wrong. If the economy avoids recession, if we manage to find some sort of equilibrium, stable equilibrium with low unemployment, and we can generate growth from these new productivity enhancing businesses, even if that growth, by the way, is not particularly well shared socially, then potentially the equity market is not going to go anywhere near those lows from October last year. Again, I would be shocked if economies manage to avoid recessions, given the sort of wealth of headwinds that they continue to face.
Yes. OK, James, really good to get your thoughts. Aberdeen's James Athey, thanks very much for joining us. Coming up on the programme, we'll get back to some other macro themes across Europe. Liz Martins joins us, senior economist at HSBC. That conversation next. This is Bloomberg.
Price pressures overall remain strong. Inflation, excluding energy and food that I have just mentioned, declined to 5.3% in May from 5.6% in April. That's what we call core inflation. Upside pressures on both headline and core inflation are still coming from the pass-through of past energy costs increases and supply bottlenecks.
ECB President Christine Lagarde, of course, reiterating yesterday that rates will rise further to regain control of prices. Let's talk about the European economy then. Liz Martins joins us, senior economist at HSBC. And Liz, in terms of the ECB, did we just cement expectations then on hearing those words from Christine Lagarde that we will get further hikes from the ECB and one of those will come next week?
Yeah, I think so. I mean, obviously, there was some welcome downside news in European inflation in the numbers that we got last week. Not universally, but for most of the major markets. But clearly, nobody came to the conclusion that inflation is dead in Europe. Actually, that number she mentioned, 5.3% core inflation, is still well above the comfort zone. So we do think that, yes, they hike next week, 25 basis points. I think that's quite consensus, according to the markets and economists. But also, we think they do it at least one more time afterwards, and probably twice.
A month or so ago, we got German factory orders that fell by 10%. Bit of a shock to markets, much worse than expected. Today, we got a number that wasn't as big a miss to the downside, but it's certainly still in negative territory, Liz, for Germany. This a reminder, though, that as the challenges around energy continue in some places, there are still parts of the industrial complex in Europe that are up against it.
Absolutely, and I think the manufacturing sector in particular, you look around Europe and globally as well, there's some real evidence of pressure here. I think probably when economists put in their forecasts for this industrial orders number for Germany, they probably thought, well, we can assume there'll be a little bit of a rebound, 2-3%, and we didn't even get that. We got a further fallback, so really quite a downbeat release. But I think, there's a few things going on with manufacturing globally. One is on the consumer goods side. Of course, consumers seem to have rotated their demand away from goods, the physical things that we buy in the shops and which people manufacture, and towards services, experiences, going out, having fun. That's a post-pandemic trend that shows no sign of slowing up. But the other thing is, of course, manufacturers don't just make consumer goods, they also make investment goods. And that maybe, I think, is starting to get hit by higher interest rates. So for a big manufacturing economy like Germany, yeah, of course, that's going to hurt.
Well, between the kind of COVID hangover that we have, and of course the war in Ukraine as well, it's no secret that monetary policy is extremely challenging, and it feels like kind of inventing a new roadmap as we go. Liz, talk to us a little bit about the decision we got out of Australia overnight. Is there some sort of lesson that can be learned from Australia for the ECB, for the BOE, or more specifically, the Federal Reserve stateside?
Yeah, I think all these central banks that you mention are in the exact same quandary, aren't they? They'd love to be able to stop raising interest rates. They see economies slowing. They see labour markets starting to turn. But unfortunately, when they look at the core inflation data and the wage data, and particularly in Australia, we had a big hike, I think, in the minimum wage, which unsettled the forecasters over there in Australia, and that meant they just didn't feel they were able to stop tightening policy. So I think that, the decision in Australia, of course, to hike by 25 basis points, it wasn't a huge surprise. I mean, we thought this was a very, very finely balanced meeting, but certainly it shows that as much as central banks would love to be able to stop tightening, broadly speaking, the data aren't allowing them to do so.
Liz, thanks very much. Thanks for joining us. Liz Martins of HSBC with some reflections on the global economy. And thinking of global economic forces, later today, Bloomberg's Jonathan Ferro hosts The Open, live from PIMCO's headquarters in Newport Beach, California, of course. He'll have exclusive conversations with the PIMCO CEO, Manny Roman, CIO, Dan Iverson, Global Economic Advisor, Richard Clariter, and other top executives. That is today at 9 a.m. Eastern Time. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Let's take a quick look at some of the stocks we're watching in pre-market trading stateside. Anna, top of everyone's mind seems to be the Apple story. We, of course, know that they released their new headset with a pretty hefty price tag. Those shares down about 0.6%. And Anna, I always wonder with Apple, who is their main competitor? They kind of dabble in a little bit of everything, but who are they really competing with?
Yeah, and a lot of focus on who are they really selling to in this particular case. If you're thinking of Vision Pro, as we were hearing from our colleague Alex Webb at the top of the programme, a lot of focus on that price tag and the name Pro, and does that suggest it goes to a business audience, not quite so mass market? So that's an interesting one to reflect on. We're also focused on other tech themes today, not least of which the tech names that could be influenced by TSMC and the amount of capex it's going to do.
Yeah, it's interesting when we talk about just kind of this supply chain shortage turned a weakness, essentially. The idea here simply being that 2 years ago, there was a major kind of demand for supply chains. Now there seems to be a big glut of chips in particular. So Taiwan semiconductor manufacturing company, TSMC, trading out of TSM, by the way, the ADRs stateside higher by 0.2% as they talk about cutting back. Efficiency is a really key part of that story. What's interesting, though, is it's not having the ripple effect into other chip names like NVIDIA, like AMD, or even like Intel, for example, which again is interesting as Apple specifically. I'm going to connect it back to our previous story, Anna. Apple talking about making their in-house chips, something that again eliminates one of the major customers for the likes of Intel, NVIDIA, AMD, and of course TSMC.
Yeah, we have some negative movers on the technology space here, the likes of ST Micro and Infineon, but not falling by a huge amount. Well, ST Micro down by 1.6%. Also under pressure, though, in Europe, Kriti. Certainly some of the energy names. This is by far and away the worst performing sector in Europe today. Energy stocks down by 1.5%. We have a big move downwards in the oil price itself, and it really does raise questions about just what kind of floor the Saudis have managed to put under oil. We're at 75.38 on Brent, and this is having an impact on expectations for oil companies as we get towards the start of trade in the US.
Exactly, and the spread, by the way, between Brent and NYMEX is certainly something to watch about. 70.81 stateside here, Anna. We're talking about it really testing that key 70 level. The read-through, though, when you see that weakness into NYMEX crude is simply more weakness in a lot of those names that are extra exposed to stateside production. I'm talking about Marathon Oil, Apache, Halliburton, all down to the tune of anywhere between 2.8% to 3.6%, that kind of range. And it really speaks to the idea that these are your three worst performers in the pre-market. So that energy weakness you're seeing in Europe, Anna, likely to kind of flood into the U.S. as we get into the opening bells.
Yeah, absolutely. A lot of focus then on energy stocks, focus on technology. Could we get in any of the sessions soon to a bull market, technically defined perhaps, up 20%, of course, on the S&P? That was the conversation yesterday, but we didn't manage to get there. We have to play that one on another occasion, perhaps. Or is this not really a bull market? That's the view of Morgan Stanley. They say the narrowness of this, and we heard from James Athey over at Abrdn. He was agreeing the narrowness of this does not make it to seem like a classic bull market. That is it for Early Edition. Surveillance is ahead. Wells Fargo's Anna Han amongst the guests on the programme. This is Bloomberg.